In Chapter 9, we will be looking at current liabilities and contingent obligations. We'll be looking at the characteristics of a liability in detail, the nature, classification, and valuation of current liabilities. We'll identify, measure, and record current liabilities based on a contractual amount. Understand and record current liabilities where amounts are determined by operating activities. Identify and account for contingent obligations, including warranties and premiums, and describe the presentation and disclosure of current liabilities and the contingent obligations. So what is a liability? These are probable future sacrifices of economic benefits arising from present obligations of a company to transfer assets or provide services. Remember, unearned or deferred revenue, when the customer pays us and we owe the service. You're going to do that in the future as a result of a past transaction. If they're probable, this refers to what can be expected or believed based on available evidence or logic, and their obligations. These refer to duties imposed legally or socially, which one is bound to do by contract, promise, or moral responsibility. So more of a definition of those items within liabilities. Liabilities include legal liabilities. They are incurred in transactions that are contractual to pay cash or to provide goods or services to other entities. In the future, so examples: accounts payable, notes payable, taxes payable, and wages payable. Equitable and constructive liabilities include those obligations where there is no legal requirement for assets to be transferred, but a transfer of assets typically occurs as a part of normal operations of a business. Vacation pay or year-end bonuses are some examples. So those are what liabilities are and the different types. Now, on our balance sheet, we categorize between current and long-term liabilities. Current are obligations that a company must meet within a year or normal operating cycle. For most companies, the operating cycle from cash to inventory to receivables and back to cash is less than 1 year, and therefore the usual classification criterion is 1 year. Liquidity refers to how quickly a company can convert its assets to cash in order to cover operating costs and pay its liabilities when they become due. So financial statement users predict future cash inflows from liquid assets relative to future cash outflows needed to meet liabilities coming due. That's why we have a current asset. Here's the assets that will be available in the next year to use in current liabilities. That's what needs to be paid in the coming year. So financial flexibility refers to the company's ability to use its assets to adapt to change and to take advantage of opportunities. So a more liquid company generally has greater financial flexibility. So one that can convert its assets to cash more quickly. So here's a great flow chart of current liabilities. Contractual, and they're the common ones, amounts determined by operating activities, accrued expenses, employee withholdings, payroll taxes, compensated balances, bonuses, sales and use tax, income taxes, unearned revenues. And then the final area of current liabilities are contingent amounts. So we're going to go through all of these different types of current liabilities in our presentation. So how are current liabilities actually valued on the balance sheet? Well, conceptually, a company should record and report its current liabilities at present value. In practice, however, most current liabilities are measured, recorded, and reported at the maturity or face amount. And the reason that is because usually the time period is so short that it doesn't make sense to report it at its present value. It's really immaterial, the interest that would be associated between the due date and the present value. And here's just an example of Nike's current liability section. You could take a look at it. It's also in your book. And you could look at those questions on your own. When current liabilities are based on a contractual amount, the liability and its maturity amount are known with reasonable certainty. The accounting issues we discuss in this section for each current liability are first identifying the item, measuring it, and recording it. So let's take a look. Trade accounts payable are a common contractual liability. Accounts payable are obligations to suppliers, we know that, arising from purchasing inventory, supplies, or services on account on credit. All accounts payable must be recorded in the proper accounting period. Issues arise when a company purchases inventory near the end of its accounting period and the goods are in transit. We know about this. The ownership of goods in transit is determined by whether the terms are FOB shipping point or destination. So that would guide us in recording an asset in inventory and also a liability. The amount of the trade accounts payable usually is determined by reviewing the invoice, which specifies the exact amount owed and the date payment is due. When cash discounts are offered, a company has the option of recording the inventory and the liability at the gross amount or net amount, and we saw that in our inventory chapters. So just to review that. Another contractual liability is a note payable, and this is a promissory note. It's a written contract that requires the borrower, and that would be the person recording the liability or the company recording the liability, to repay a sum of money on a specific date. It may be classified as short-term or long-term. Now, notes payable normally result from purchasing goods or services on credit or borrowing money. The ability to obtain short-term financing with notes payable is often a key component of a company's working capital strategy. So in order to pay its bills, can it borrow any money? While the promissory note is the source document used to determine and record the amount of the liability, interest also plays a key valuation role. So if the note payable is interest-bearing, meaning there's a stated interest rate on the note, so the principal will be paid back plus interest, you have an interest-bearing note. Non-interest-bearing is that a lower amount is actually borrowed and it's the principal that will be paid back when the note matures. For an interest-bearing note, the face value of the note is its present value because you are paying interest on top of that at market rate. Therefore, the liability is recorded at an amount equal to the face. Interest is accrued over the life of the note by applying the interest rate from the note. Example: Titan Corporation uses a perpetual inventory system and purchases merchandise for $7,000 on December 1st by issuing a $7,000 12% 30-day note to the supplier. Titan records the issuance of the note, the accrual of the interest at the end of the year, and the payment of the principal and interest as follows. On December 1st, when they purchase the inventory, debit inventory, credit notes payable, $7,000, the face of the note. At the end of December, 1 month of interest has accrued. So they'll debit interest expense for $7,000 times 12% times 30 over 360, the number of days. $70 is debited to interest expense and credited to interest payable. When the note is paid off on January 1, which is the next accounting year, they'll debit interest payable. None of the interest expense happened in 2017. So there's no interest expense account used. Debit notes payable for the full 7, and they're paying cash of $7,070, principal plus interest. Now, if it's a non-interest bearing note, it doesn't have an explicit interest rate. However, interest is implicit because the note, the borrower does not borrow the face amount. They borrow actually a discounted amount. Interest is subtracted from the face amount, and that's what the borrower actually gets on the day they receive the money or borrow the money. Interest expense is then recorded for the difference over the life of the note. Take a look. Borrowing money. The effective interest rate for 3 months, 1/4 of a year, can be determined as follows. Total interest paid divided by the amount borrowed. Not the amount paid, the amount borrowed. So they borrow $300, or I'm sorry, they borrowed $9,700. That's the amount of cash borrowed. They have interest of $300. So for 3 months, it's a 3.09 interest rate. Well, that's only for 3 of 12 months. We want to know 12 months. So you can multiply that by 4, and that will give you 12.36. That's the effective annual interest rate. Another type of contractual borrowing is a line of credit. It's an agreement that allows a corporation to borrow up to a certain dollar amount of money. They don't have to borrow all of it. They can if they want. A non-committed line means the corporation does not have to follow any formal loan procedures or complete the normal paperwork. A committed line is more formal, that normally requires a corporation to pay a commitment fee, to have access to the funds, providing with flexibility to borrow when needed. So it all depends on what kind of line of credit is set up at the bank the corporation is using. Commercial paper is another type of contractual liability. It's an unsecured, so there's no collateral on it, no payable. That's commonly used to finance accounts receivable and inventories, as well as to meet other short-term obligations. So commercial paper generally has a maturity range from 30 to 270 days. A major benefit of commercial paper is that it does not have to be registered with the SEC, as long as it matures before 270 days. Currently maturing portion of long-term debt is another type of contractual liability, and it's a really weird one because generally what we do is we have a long-term liability account, say, or a note payable long-term. We don't do any journal entry for this. We just say, of that balance in our long-term liability account, how much of it will we pay next year? How much of it will we pay next year? And we do that on the balance sheet date when we're making the balance sheet. And that portion of that account is called current maturity of long-term debt, or current portion of long-term debt. And that part is listed as a current liability. The remaining amount would be listed as a long-term liability. Take a look. Brown Company has issued a 20-year bond that mature on July 1, 2017. Brown reports the bonds as long-term liabilities in 2015 and prior balance sheets. However, because the amount is due on, that's wrong. I think they're supposed to step before that says July 1, 2016, that should say, not 17. Because the bonds mature on July 1, 2016, those bonds would be reported as a current liability on the 2016. That's all messed up. Let's do this again. Okay, if Brown Company has issued 20-year bonds that mature on July 1, 2017, leave that date there. They've listed them as long-term liabilities. Okay. They mature on July 1, 2017. The bonds will be reported as a current liability on the December 31st, 2016 balance sheet because they'll be paid off by the end of 2017. Okay. Here's another situation. Assume that on July 1, 2015, Rexlow Corporation issues 9% bonds with a face value of $1 million. These bonds will be retired in installments of $100,000 beginning on July 1, 2017, and for each year thereafter until all the bonds are retired. Rexlow's December 31st, 2016 balance sheet won't have all $1 million bonds payable as long-term. Instead, the first installment that will be due during 2017 will be listed as a current liability. So $100,000 of the million will be under the current liability section. The remaining $900,000 of bonds payable will be listed as long-term liability. And that's what we're talking about here. Another contractual liability could be short-term debt that is expected to be refinanced on a long-term basis. So maybe you have a loan that's coming due next year and you already started refinancing it so that it won't be due for 20 more years. Well, you may not want to list that as a current liability. It may be listed as a long-term. When will it be listed as long-term? There's an intent to refinance on a long-term basis, so the obligation won't require any money next year, and you have the ability to refinance. The company has the ability to refinance when it refinance the obligations by issuing long-term obligations or equity securities after the date of the balance sheet. So it occurred. So they actually did do the refinancing, or they've entered into a long-term financing agreement. So you have the ability to do it, and you've started the process is basically what we're looking at, or the process has been completed. If a company repays a short-term debt after the balance sheet date and then later issues long-term debt or common stock before the balance sheet actually is published, GAAP requires that such short-term debt be included in current liabilities at the balance sheet date. Obligations callable by a creditor. What does this mean? Sometimes if sometimes a loan, there may be an option for a creditor to make you pay it at a certain time, or if you don't follow certain rules, you may be obligated to pay it. So obligations callable by the creditor. So if a company violates a long-term debt agreement, and that's what I was just talking about, you broke the rules, and the liability becomes callable by the creditor within 1 year, the company reports the entire amount of the long-term obligation as a current liability, because you probably have to pay that in the next year. If you broke a rule in your loan contract, and part of the punishment is that you have to pay the entire loan off, then yeah, you should record that as a current liability. There is an exception. The exception to this requirement is a callable obligation that meets one of the following conditions. The creditor has waived the right to request repayment for more than a year. So they're going to make you pay it, but you don't have to do it over the next year. Or it's probable that the company will resolve the violation of a debt agreement, and so it won't be callable, basically. Sorry about that. Okay. Dividends payable. Here's another contractual obligation. When a company's board of directors declares a dividend, it reduces retained earnings and recognizes a current liability if it expects to distribute the dividend within the following year. And that's usually the case. So the entry to record the declaration, remember there's 3 major dates on a dividend. Declaration, that's when the board of directors declares they're going to pay money in the future. Well, when the board of directors declares or promises to pay an asset out, a liability is created that day in dividends payable. So we debit retained earnings, credit dividends payable. There are 2 exceptions to the recording of dividends as a current liability. Remember, in this example, they are promising an asset, cash. What if they promise a stock dividend where they're distributing more stock? That's not creating a current liability. A company does not report undeclared dividends in arrears. And you kind of got to take yourself back into dividends. Remember, preferred stockholders. Preferred stockholders are basically promised an annual dividend if they own cumulative stock. However, they may not always receive the cash each year because the corporation may not declare a dividend each year. So any year that a preferred shareholder does not receive their dividend, the company kind of writes it on a piece of paper on the side and says, hey, we didn't pay them that dividend from that year or that year or that year. And then when they do declare a dividend, all those dividends that they never paid out, called dividends in arrears, are paid first. So they're not an official liability on the company's books because they didn't promise to pay anything out. But they just keep track of it on the sign saying, when we do promise to pay it out, they got to get all those things we never did pay them because we never declared a dividend. Advances and refundable deposits. So many utility and other companies require customers and employees to make deposits, which are recorded as liabilities, unearned revenue, especially if they have to pay them back. Right? Property taxes. These are also a contractual obligation. and that create a liability. These are assessed by local, county, and some state governments based on the value of certain property that a company owns. They become a legal liability against the property at a date specified by the law. So it depends on where you live, but let's look at an example. Easel Company operates in Lee County, which has a fiscal year end of September 30th. Property taxes become a lien against the property on October 1 of each year. And the estimated property taxes for the period October 1, 2016 through September 30th, 2017 are $7,200. Easel receives a tax bill of $7,290, which it pays on January 15th, 2017. Easel's entries to record the monthly accruals and payments relating to property tax are presented next. So if they make a journal entry each month or just one big one as of the end of the year, they have to accrue 3 months, it looks like, yes, 3 months of property tax, 2 months, I'm sorry, 2 months of property taxes, November and December. 7,200 divided by 12. No, I said that wrong. 7,200 divided by 12. This would be the monthly adjusting entry. So each month, at the end of the month, they debit property tax expense 600, credit property taxes payable. When they pay the property taxes, they'll debit property taxes payable for the $1,800 that they recognized in property taxes last year, and debit an asset prepaid property taxes, and they'll expense those throughout the remaining part of the year. Credit cash for the total amount they paid of $7,290. So each month for the next 9 months, they'll take the remaining $5,490 and expense it. $5,490 divided by 9 is $610. So property tax expense is debited $610, prepaid property taxes credited $610. There was a difference, as noted below, of $90 between the actual and estimated taxes, and that happens sometimes. The point is that you create an estimate and you record property tax expense in the proper year. And this is showing you how it should be recorded. The next learning objective deals with current liabilities determined by operating activities. Some of the common ones are unearned revenue, wages payable and payroll taxes, bonuses, compensated balances, sales and use tax, and income taxes. So, unearned or deferred revenue we've seen already. This includes amounts that we collect in advance but have not satisfied the performance obligation and therefore cannot record them as revenues. These are listed as liabilities because we still owe them. And they're either going to be a current or long-term liability depending on when the performance obligation is satisfied. So when you're going to do the work. Common examples of some unearned revenue are amounts collected from customers in advance, such as rent, magazine subscriptions, tickets like airline tickets, gift certificates, their airfares, memberships to like gyms, insurance premiums and insurance companies, and service contracts like Ehrlich or something that you pay in advance. Take a look. July 1, 2016, Cook Publishing Company sells $80,000 of 2-year magazine subscriptions in advance. On that day, Cook will debit cash, credit unearned revenue. At the end of the year, when they've provided 6 months worth of those subscriptions, they'll debit unearned revenue for $20,000 and now credit subscription revenue $20,000. That's assuming that they don't make any adjusting entries for the monthly. How do we get the $20,000? $80,000 times 6 months divided by 24 months, because that $80,000 is for 2 years of subscriptions. Accrued liabilities are expenses that have been incurred but not yet paid nor recorded anywhere. These liabilities are usually recorded as adjusting entries at the end of the accounting period, like salary expense for the portion of the salaries that are not recorded yet as an expense but the employees completed the work by the end of the year. Debit salary expense, credit salary payable. Liabilities related to compensation. All companies incur liabilities relating to compensating their employees. These liabilities include amounts owed to employees for salaries, withholdings from employees' pay, whether they be voluntary deductions or payroll taxes, and other compensation-related liabilities, such as compensated absences like vacation or sick, and bonuses. In most cases, all of these liabilities are reported as current liabilities because employees aren't waiting for more than a year to get that money, right? So let's take a look at the different types of withholdings that may create a current liability. The first is federal income tax and state and local income tax. These governments require employers to withhold from the pay of each employee a legal amount for the anticipated income taxes the employee will owe to each part of the government, whether it be the federal government, state, or local. So employers are required to withhold an amount for taxes out of the employee's paycheck and send it directly to the government on the employee's behalf. And that's what the second bullet is saying. Employers determine the amount by using applicable legal rates and by information provided to them by the employee. Another type of tax is the FICA, Federal Insurance Contribution Act. Federal Insurance Contribution Act, FICA. These are taxes withheld from the wages of each employee and employers. So not only do employees pay these taxes, but employers do as well. Employers must remit the sum of both taxes, the employee's portion that's withheld, and then the matching the employee's portion to the federal government and file a Form 941. Federal unemployment tax is different. This is an employer tax, and it's usually determined on the first $7,000 of an employee's wage. Employers only are required to pay it, but to calculate it, employers use the first $7,000 of an employee's wage for that year. Once an employee reaches $7,000 in gross salary, they no longer have to use those wages to calculate federal unemployment. Right now, the federal unemployment rate is at 0.6% or 0.006. So here's an example or a nice little table here. Federal income tax is based on graduated rates, meaning it depends on what the employee tells the employer about themselves. If they're single or married, how many dependents they have. Same with state sometime. Taxes are computed on 100% of the employee's salary. Okay, so we don't subtract any taxes out to compute another tax. When it comes to FICA, there's two major parts of FICA. The Federal Insurance Act says OASDI, which stands for Old Age Survivor Disability Insurance. First of all, it's a 6.2% tax rate on the gross pay, and this is from 2000. That's actually 2016 up there. They didn't change these slides, but that's the 2016. The first 117,000 of an employee's gross wage will be taxed at 6.2%. Once an employee makes 117,000 in 2016, they stop paying that tax. In 2017, it was 127,900. I'm not sure what it is for 2018. Medicare tax is the other portion of FICA tax, and that all 100% of an employee's wages are used to calculate that tax. So it doesn't matter how much money you make, you're always paying that tax. Federal unemployment tax is not an employee withholding. It is an employer tax only. That's why you only see rates in the employer column. 0.6% of the first 7,000 of an employee's. So each employee they look at. Once each employee reaches 7,000, they stop using those wages to calculate federal unemployment. Same with state. State's usually about 5.4%, so that's the rate they use here. And it's also the same rule. It's an employer tax normally, and it's based on the first 7,000 of an employee's wage. If you look at this table, there's also a 6.2% and 1.45% for OASDI and Medicare in the employer column. And that's true because employers have to match what an employee pays as part of a separate expense. Those are employer payroll taxes. So employers pay a match of what the employee pays for FICA, also federal and state unemployment. There's also voluntary deductions that an employer may offer to employees. Maybe the employer will say, you're in a union, you owe them dues. Instead of you writing a check to the union, we'll just withhold that out of your paycheck and send that directly to the union for you. Same with life insurance. We have a life insurance policy here that we can offer you. You have to pay the premiums. We'll deduct the amount out of your paycheck. 401k, the retirement savings accounts, they work the same way. And that bottom little asterisk, that's gone away. So let's take a look. Wager Corporation has a weekly payroll of $28,000, all of which is subject to federal insurance, FICA tax. 6% on employee, 8% on employer. They're just giving you these amounts. It's not normal. Federal unemployment tax is 0.6% and state unemployment tax is 5.4%. In addition, federal and state tax withholdings were $1,980 and $1,000 respectively. A voluntary payroll deduction of $360 was made for union dues on all the employees. So what they do is they take and calculate all their employees' paychecks, and then they total up the gross wages. They total up all of the deductions in the major categories there and get an overall net pay once they subtract those. How much did the employee actually take home overall? So the salaries expense will be debited for the gross pay, $28,000. No matter what, the employer has to pay out $28,000 for this employee. Some of it is paid directly to the government. Take a look. FICA taxes payable, 6% of $28,000. So all those employees who made up that $28,000 payroll paid a total of $1,680 for FICA. And what that FICA amount includes OASDI and Medicare. They just simplified it here. Federal income taxes, they told us, were withheld of $1,980 from that $28,000. State income taxes, $1,000, and union dues, $360. So the employees never saw those withholdings. Instead, the employer says, we won't pay them to you directly. We'll send them to the federal government, state government, and the union on your behalf. The day that they record the salaries, the employer records each of those withholdings as a liability. They owe those. So hence the word payable there. The amount that goes to the employee, the net pay, is credited to cash, $22,980. The next thing the employer does is record their payroll taxes. Remember, the employer basically matches, but this is a little bit higher, 8% times $28,000. It's normally a match in the real world. So the employer, because they have employees, will also have to pay FICA tax payable $22.40. So they'll credit that liability account. They'll owe federal unemployment taxes of 0.6% on $28,000. Remember, that's 0.6. That's not even 1%. So it's 0.006 in a calculator. So they'll credit that liability account $168. And then state unemployment tax, same thing, 5.4% of the $28,000. We store that in the current liability account, $1512. When you add those up, the employer will debit payroll tax expense, which is separate than salary expense, $39.20. That's extra they have to pay because they have employees. That's a great review of payroll. Really look at that. Compensated absences. These are things like vacation, holiday, illness, or other personal activities for which a company pays its employees. A A company recognizes an expense and accrues a liabilities for employees' compensation for future absences if all the following are met. The company's obligation is based on the employee's services already rendered. So you basically earn as you work. You earn a day off, you earn time. The obligation relates to rights that vest, so the employee will be paid even if the employment is terminated, or it'll accumulate. Unused benefits can be carried forward to a period subsequent of when they were earned. So that needs to be present. One of those have to be present. Payment of the compensation is probably going to happen, and it can be reasonably estimated. So if you have all of those items, we can move forward with compensated balances. Vacation pay is earned as a result of past employment. Therefore, the company must recognize an expense and accrue a current liability as it's earned. If sick pay benefits vest and are not used by the end of the period, the employer must recognize an expense and accrue a current liability for those sick pay benefits. So there's a flow chart of what we were just talking. When it comes to employees' work, vested or accumulated unused vacation benefits must be accrued. Vested unused sick pay benefits must be accrued. Accumulated but not vested sick pay benefits may or may not be accrued. Take a look. Milton Company has 100 employees who are each paid an average of $200 per day. The company has a policy which meets the conditions set forth by GAAP for accrued absences, or compensated absences, of allowing each employee 12 days of paid vacation per year. The total annual cost of the paid vacation is $240,000. 100 employees, 12 days, $200 per day. Assuming no vacation days were taken, that should be in 2017, Milton makes the following entry at the end of the year. Debit salaries expense, because we recognize it the year it is earned, $240,000. Credit liability for compensated absences, $240,000. So we've adhered to the matching principle. Assuming all vacation benefits were actually taken the next year, and that should say 2018, not 2015, Milton would record the payment of vacation pay as follows. So as they're paying this, any compensated vacation pay that they accrued last year, they'll debit the liability for compensated absences, credit cash. So the assumption there is all of them were taken. If the employees receive a raise during 2018, that should say 2018, so that their average pay rate went from $200 to $225 a day, that $25 difference is recognized as salary expense. The part that is not accrued would be recognized as salary expense. A bonus computation. Here's an example. Bonus Corporation reported income for the next year of the current year, of $260,000 before deducting income taxes and before a bonus to the Chief Executive Officer. Bonex's current tax rate is 30% and the bonus rate is 10%. The bonus applies to any income before deducting income taxes, and the bonus above $100,000 above $100,000. The bonus is calculated as follows. Income subject to bonus rate would be 260 minus 100 because it's the amount above 100,000. Multiply that by 10%. Because the bonus is a tax-deductible expense, income taxes are then computed based on $260,000 minus the bonus of $16,000. So the income tax rate of 30% would be applied to that difference. Income taxes would be $73,200. So just an example of how we handle bonuses. Bonex will then record salary expense $16,000, bonus payable $16,000 in the year it accrues, in the year that the net income occurs, and then debit income tax expense and income tax payable for the amount of the income tax. And they're all current liabilities. Sales tax is levied by a government authority on the transfer of certain goods and services. I think we've all had the sales tax charge. It's usually the retailer or the seller who must collect the sales tax from the customer and then remit it to the governmental unit. A use tax is levied by a state or local government on goods bought from a vendor from out of state who doesn't collect your local sales tax. So it's you paying that state's sales tax. They just call it a use tax because you're using the item in your state that you never paid sales tax on. Example, Celeroy Company sells merchandise for cash with a retail selling price of $50,000, of which a sales tax of 6% is levied. The company collects $53,000 from its customers and records the collection as follows. Because it's the retailer, the seller here, Celeroy, who's responsible for collecting the sales tax, their sales or their revenue is what they charge the customer for the item, $50,000. But $50,000 times 6%, they would have to charge them an additional $3,000 because of the sales tax charge. That is credited to a current liability, sales tax payable, because they have to send that to the state. And then cash is debited for $53,000. Notice we don't keep separate accounts for the cash. Now, different states require the payment of sales tax from the company collecting it at different times. I can tell you Pennsylvania, it's monthly. So that sales tax payable will sit in that account until it has to be paid to the state. At that time, Celeroy will debit sales tax payable and credit cash for the amount they have to remit. Sometimes sales tax is included in the sales amount. Take a look. Smalley Company collects sales taxes but includes the amount of the sales tax in the price. In other words, it records the combined amount of both the sales and the sales tax in the sales account. At the end of January, sales account had a credit balance in it of $169,600, but remember, that's sales and sales tax. So they have to now separate and record the proper amount of sales tax. We're assuming it's a 6% sales tax. So what's really the $169,600? It's 100% sales revenue, 6% sales tax. So if we divide the $169,600 by 1.06, it'll tell us the amount of that's in that account that is sales tax, and it's $9,600. So at the end of the month, debit sales, credit sales tax payable. Not all companies do that, but if they do, that's how you pull out the sales tax portion. Income taxes we saw. With corporations, they are subject to federal income tax. Some are also subject to state, local, and foreign taxes. There's different way of taxing. It's usually a multi-step progressive structure. Some are taxed as low as 15%, as high as 35, 38%, but that has dropped with the new tax law. The point here is that when a corporation figures out its income taxes, it debits income tax expense and credits income taxes payable until they are paid. Contingent obligations. In the normal operations of a company, transactions, events, and commercial arrangements sometimes give rise to uncertainties, contingencies, regarding whether the company will experience a future gain or loss because of something that's happening now. This uncertainty will ultimately be resolved. But do we record these contingencies? And the rule is, if it's a loss contingency, it may be recorded. And here's the guideline. If it's probable that the future event is likely to occur, then we definitely record a journal entry for it. If it's reasonably possible, then we include a note to the financial statement. And if it's remote, we don't need to do anything with it. But we need to define it in terms of one of those three categories. The company must assess also whether or not it can provide a reasonable estimate. Okay. A company accrues an estimated loss from a loss contingency if both the following are met. It's probable that it's going to happen, and they can reasonably estimate the loss. This is a great flow chart. So future event probable, if the answer is yes, can you reasonably estimate it? If the answer is yes, report it directly into your financial statements. Make a journal entry for it. If the future event is not probable, or if you cannot reasonably estimate it, then you go to the next area. A reasonable possibility of loss. So if it's a probable event, you can estimate it, you make a note to your financial statements. Okay? If it's a reasonable possibility of loss, note to the financial statement. And then if it's not reasonably possible, it's remote, you don't need to do anything. There is an example of Apple's contingencies. Read through that and you could see it's usually lawsuits that are contingent liabilities or end up in the notes to the financial statements. So you could look at those. Another example of a contingent obligation is a warranty. Warranties are offered in connection with the sale of products. An assurance type warranty is a warranty in which the seller promises the customer that a good or service will function. If it does not function as specified, it requires the seller over a specified period of time after the sale to correct the defect. A service type warranty is a warranty in which the seller provides a service to a customer in addition to the assurance warranty that the delivered good or service will function. A service warranty represents a distinct service and is usually sold separately. GAAP requires a company to recognize any warranty costs associated with an assurance type warranty as an expense in the period which it makes the sale. So you don't wait till the warranty is used by the customer. You estimate the warranty expense associated with the sale that has an assurance warranty on it and record it as an expense and a liability in the year of sale. Here's an example. Angley Machinery Corporation sells 200 machines at $6,000 each during 2016. Each machine carries a 1-year assurance warranty. So it's not being sold separately, it's part of the sale price. Experience has shown that the warranty costs will average $150 per unit. There's our estimate. Angley spent $5,000 in 2016 and $25,150 in 2017 to fulfill these warranty agreements for the machines sold. So in the year of sale, they'll debit cash or accounts receivable and credit sales revenue for $6,000 times the 200 machines. That's the actual sale. But in the same year, they will also debit warranty expense and credit estimated warranty payable for $150 per machine times 200 machines, because that's what they estimate it will cost them to fix them because they've provided this assurance type warranty. In 2016, they actually did pay or have to cover $5,000. So they debit estimated warranty liability and credit cash, assuming they had to pay cash to satisfy the warranties. In the following year, they'll debit estimated warranty liability $25,000, the remaining amount that was accrued in 2016, debit warranty expense for the excess of $150, and credit cash for $25,150. So the point is that even if it's probable, you still estimate and record the expense and the liability for a warranty, the assurance type, in the year of sale. Okay, I'm going to keep going past this. Service type warranties. These are warranties that are often priced and sold separately. As I said, under this method, a company actually defers revenue from the sale of these warranties until the warranty is actually used. Wagoner Electronics offers its customers a 3-year extended warranty that protects the customer from defects beyond the manufacturer's 1-year warranty. On January 2nd, they sold $3,000 in televisions. They also sold extended warranties for $240. So they'll debit cash for the total of $32.40, credit sales $3,000, and credit unearned warranty revenue liability $240. If Matt returns the television for warranty services that cost $200 on June 30th, 2017, Wagner will debit warranty expense and credit cash. Wagner then makes the following entry for 2017, 18, and 19 for the periods that are covered. They'll debit unearned warranty revenue and credit warranty revenue. Recognize the revenue from selling the warranty over the life of the warranty. Recognize the expense associated with that extended warranty the year you actually have to pay out on it. The final area we're going to look at are premiums, coupons, and cash rebates. So many companies offer premiums such as toys or dishes or CDs in exchange for labels, coupons, box tops, and wrappers. Other companies offer coupons. Still others offer a cash rebate when a customer returns a cash register receipt for the purchase of their product. All of these offers are intended to increase a company's sale. Therefore, any cost associated with premiums, coupons should be matched as expenses as revenues in the period of the sale. On October 1st, American Spaghetti Corporation began offering customers a spaghetti serving fork in return for 30 spaghetti can labels. The offer expires April 1st, 2017. The cost of each spaghetti fork to American Spaghetti is $2, and based on past experience, the company estimates that only 60% of the labels will be redeemed. During 2016, the company purchased 6,000 spaghetti forks, remember, at $2 each. It sold 300,000 cans of spaghetti at $1.80 per can. From these sales, 105,000 labels were returned for redemption in 2016. Here's how the company will record journal entries related to this information. First, record the spaghetti forks as inventory of premium, 6,000 spaghetti forks, $2 each. So they now have inventory of premium items. They're not going to sell them. They're going to give them away when they get back the spaghetti tops. And credit cash. Record the sale of the 300,000 cans of spaghetti at their selling price. Now we estimate the total premium liability related to the sales. Well, they sold 300,000 cans of spaghetti. They determined that 60% of those sold will be redeemed. We'll use the coupons for redemption, or 180,000. Okay, so that means now they have to calculate how many spaghetti forks do they think they're going to send out. 180,000 labels divided by 30 labels per fork times 2 for $2, $12,000. So it just happens they think they'll send out all the spaghetti forks they sold. So they debit premium expense, credit estimated premium liability. Not inventory, not until they send them out. Now what happens when they do receive 105,000 labels? Well, they'll take the 105,000 divided by 30. That's how many forks they're going to send out, times $2. Credit the inventory of premiums because they just sent those forks out. They no longer have them in inventory. Debit the estimated premium liability. So every time they actually send the forks out, that would be the journal entry. And that's how we deal with premiums. On January 1, Eat Well Cereal began offering a cash rebate of $2 to customers who returned 5 coupons contained within cereal boxes. That offer expires December 31st. They determined that about 30% of the coupons will be redeemed. The company sold 1 million boxes of cereal, $4 each. 250,000 coupons were actually redeemed, and 50,000 coupons were unredeemed at the end of the year because 30% or 300,000 of them would be. So they'll record their sales, cash $4 million for the 1 million boxes, sales revenue $3,880,000. Estimated rebate liability is $120,000. $300,000. Let me get my calculator. Or 300,000 boxes are expected to be redeemed. For each 5, you get $2. So 60,000 of these offers will actually transpire. Multiply that by $2, $120,000 is how much they expect to have to pay out. As the coupons are redeemed, when 250,000 of them are redeemed, divided by 5, so one offer, there's 50,000 offers going out at $2 each. They'll pay $100,000. They reduce their liability as such. The coupons that expire, they'll debit estimated rebate liability to remove so that balance is gone, and then credit sales revenue because they just got that. That's money that they never recorded that they thought they would have to pay out. It's actually sales revenue now. If a company has a gain contingency, there's a potential increase in an asset, and there's some examples of when. They're usually not accrued, but they may be noted in the financial statements. So they're not in the balance sheet or income statement, but they're noted in the notes. So the rest of this talks about the required note disclosures, and I'm just running out of time with when I'm recording. So you could read through it. It's pretty self-explanatory, and you could post any questions you may have on the discussion board. And there's a disclosure for General Mills for their current liabilities and long-term liabilities.